All right. Today is Sunday, the 4th of May. Happy Star Wars Day. May the 4th be with you. I know the day's already over, so I hope you had a good 4th of May, but for viewers in Hawaii, maybe you still got a little bit of time to enjoy it. But this is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Now, I want to begin this show with, of course, the most important news that we got today, which is legendary investor, the man who pretty much inspired all of us to get into this business to begin with. Warren Buffett is going to retire. It is, of course, an end of an era, because when you think about this man, let's think about a sports analogy. You think about Babe Ruth or Michael Jordan or Muhammad Ali. They're the best who ever played the game in their field in sports. And if investing was a sport, Warren Buffett will be on top and nobody else comes even close. And I don't think we're going to see anybody who's going to replicate the performance and the success and the wisdom that Warren Buffett and his investors enjoyed. And of course, we got to learn something from it. But as I said before in the previous video when we talked about Warren Buffett, actions speak louder than words. And when you see the cash pile that Berkshire Hathaway is raising, of course, throughout the years, Berkshire Hathaway been raising cash consistently. And we all know why. Warren Buffett loves value and he looks for really deep value before he invests, and he'll take his time. He's the guy who said, think about it as a baseball bat. You don't have to swing every time. You only swing when you know you're going to hit. You only swing for the right one. And he's willing to wait. But we haven't seen Berkshire Hathaway raising this much cash. This acceleration of raising cash, now we're almost at $350 billion. I think at some point they want to raise $500 billion. And why would you do that if the economy is doing great and the market is going to go higher and everything is going to be beautiful in the next few years? It doesn't make sense because they're raising all of that cash, awaiting bad economic times, bad markets for a little while. And then they're looking for a point when we see real blood in the streets, extreme pain that meets extreme pessimism. And then they're going to begin to find opportunities. Of course, whether Warren Buffett is going to be with us at that time or not, who knows? Berkshire Hathaway is going to be led by somebody else anyways. But we all know that Buffett's influence dominates Berkshire's mentality, regardless of who leads the company. Now, folks, in this show, I'm going to concentrate the conversation on the market. Do we see the macroeconomics developments that we got throughout the week or the earnings developments that we got throughout the week as good or bad for the stock market? We try to weigh the risk versus reward in this market. Of course, we're going to talk about macro when we do that, but we have produced videos throughout the week for the members discussing all of the macro that we got. So consider joining us, folks, and unlock these videos and watch them. But we're going to have a great discussion here for you tonight. And let's begin with this. Of course, we all read the headlines of we got the worst stock market performance since 1930. And fast forward, a couple of weeks later, we get one intense rally that is the best, longest winning streak in the S&P 500 in 20 years. And the beauty of the contrast between these two headlines stems from two things. Number one, the political biases. Of course, so if you're against the current administration, you are concentrating more on the previous headline, the worst performance in 30 years. If you happen to be a proponent of the current administration, you of course try to dismiss the previous headline, and now you're jerking off to this headline right here that we have the best S&P 500 rebound in 20 years. And this is why, by the way, this country is going to collapse at some point. Because we're that stupid. We're that divided. We have no objectivity at all. But that's number one. Number two, the beauty of the contrast from these headlines, that this is a clear illustration that we are in a bear market. Bear markets are known for having steep and painful declines, breaking trends, etc. But they're also known for really sharp rebounds. And it comes from, of course, something we talked about numerous times in this show. We talked about how when the shorts sit in a profitable position and then you have a reason to incentivize them to close that position and book profits, that short covering causes. It's the reason behind these sharp rebounds that we see in a bear market. But then we get to the question of, are we in the path of recovery or are we in the path of continuing in the bear market? And the key to answering that is what happens after the shorts cover. Do we see other players on the table joining the market and buying it? We're talking about the institutional investor. We're talking about the retail investor. We're talking about the traders. If they don't follow up with confidence and conviction, then the rebound dies and the bear market resumes. But it is really difficult to navigate a bear market. Not a lot of people know how to play it because they think they're geniuses when the market is easy and the Fed is manipulating the market and the bond market is being manipulated by the Treasury Department. And you see just an easy path upward. But when it comes hard like this, it's confusing. It's difficult to navigate. So the trick is to avoid, in the rebound, to avoid bear traps. And when the stocks decline or the market declines sharply, you got to avoid being too greedy in your shorts and avoiding not participating in these rebounds because they're juicy, they produce a lot of profits. I think so far we've done a good job in this channel. For example, when we got the GDP, I said this downside in the market is not convincing. And I think it's a bear trap. And guess what? It was. And we made a video about it, escaping the GDP bear trap. Well, gee, how did we know it would be a bear trap? Because we have guidelines, we have indicators, we have rebound checklists that we look at. So you wake up in the morning after the GDP reading and you see the market down. You see the indicators all pointing out that the rebound shall continue. And trusting the indicator pays dividend and lessens the degree that you're going to make bad decisions or wrong timing kind of decisions, which is really, really hard to avoid in a bear market. The question now becomes, did we see a bull trap on Friday's session? Because Friday we got the jobs data and we got some positive news on the trade front. And we've seen more participation in buying by other players on the table besides the shorts. Was it a bull trap? There is a lot of evidence that it is. And we're going to look at the indicators in a minute and make a judgment. But I think the main reason this is going to be a bull trap, if it indeed turns out to be that case, is that the market is going to shift from the focus on the trade war and focus more on the Trump versus Powell dynamic. Now, if you guys recall, if you traded 2018, the trade war with China caused a lot of chaos in market downturn. But then it cooled off. Things began to cool off. The narrative began to get better. And the market started to recover little by little by little. But then the market faced another dilemma, which is Trump versus Powell. Round number one, which Trump won, of course. When Jerome Powell, who was hired by Trump, by the way, was raising interest rates to normalize the interest rate policy. And Trump did not like that. And we've seen the market flushing down again. The resolution happened after Jerome Powell decided to fold and say, okay, I don't need to raise rates or normalize anymore. And the parallels are really important because what we're going through right now is not any different than 2018, but it is more intense and the stakes are much, much, much higher. And if you guys remember, last year I said that when folks said that Trump is going to do this, he's going to fix the economy, he's going to fix the market, tariffs this, tariff that. I said he cannot replicate the same policies from the first term. And the reason is he's playing in a different terrain now, given the inflation dynamics. And so far, we're proven right, because it's been a disaster. But I think the market right now, since we got some cooling off in the trade front, the market will shift the focus toward the Fed versus the White House. We have an FOMC meeting coming out this week. And if we see the result of that meeting and the decision that comes with it, a resumption of the conflict between White House and Federal Reserve, we will see the market flushing down again. And that's going to be the reason behind the bull trap. But before we add more color to this conversation, because I have all of the evidence for you, we're going to discuss bullish reasons for the market versus bearish reasons based on the macro and the things that we've seen throughout the week. But before we segue to that, I want to address something important, because this is not just one comment, this is a common comment that I've been getting recently. This comes from Robert Molina, who's been a viewer with us for a long, long time, so his comment holds more weight than somebody who just joined me 2 months ago. But it is upsetting because, here it is, the only issue is math seems to be the mostly bearish most of the time. Mostly bearish most of the time. One hand, he says we need a recession to wipe out inflation. The market needs to come down and valuations are going to matter. And when it does, he's talking about me now. I say Trump bad, White House bad, see what they're doing, everything's going to collapse, the dollar is done, stagflation, yada yada. Robert says yields are going to drop, China's going to make a deal, status quo will return. And I think that's what the market is pumping on. So one step at a time. Am I mostly bearish on the economy and the markets? Yes, because of the inevitable at the end. But we had pretty good positions throughout the years, and folks who've been following us know that. We had really good long positions, and we played themes. In 23, for example, the construction theme. In the third quarter of last year, I moved the majority of my pension to GLD gold, and I stated the reasons why I've done that. And so far, so good, beating the market. Now I'm advocating, and I'm telling you what I'm doing. I think the bullish opportunity is in the currency market, in accumulating more yen and Swiss franc. They will appreciate, of course, because the dollar goes down, which means that some commodities will also appreciate in value. So we've been bullish certain things throughout the years, and the records speak for itself. Everybody who's been watching the channel for a long time knows that. Now, as far as saying that, I used to say that recession is needed to wipe out inflation and valuation is going to matter. We have to do it for the sake of the country. And of course, the sooner, when you get an inflation episode in any economy, the sooner you get a recession, because recession is the natural remedy of inflation, the sooner you get it, the milder it is, and the faster the recovery. But when you try to play cute games such as soft landing by the Fed, you might buy yourself a little bit more time, and the market recovers a little bit, and the economy avoids a recession for a little bit, but then you create a stagflation problem. And in time, the market crashes, the economy goes into a recession, but this time the magnitude of the hit is much, much deeper. The recession is more aggressive than, let's say, had we accepted it back in 22. That perspective never changed. So I don't understand the challenge here, because I never flip-flopped and said, oh, you know what, inflation is great right now. We don't need a recession anymore. We don't need to get the market down anymore. And this is why when you say that I say Trump bad, White House bad, all I'm saying is, and I said that last year, by the way, I'm anti-tariff. It's a dumb policy that doesn't make sense at all. Like all of you guys heard Warren Buffett's perspective on the trade war and tariffs over the weekend. Tariffs are stupid and tariffs are inflationary. They cause prices to go higher on the consumer. So explain to me why I'm contradicting myself here, because I'm not. I'm saying inflation is bad. We need a recession to fix it. And what tariffs are going to do is stagflation. Going to exacerbate the chances of a recession, but also exacerbates the chance of inflation. And that's a dumb policy. You don't want to do that. You can't praise that policy. No matter what your political biases are, the economic policy is bad, period. And it was handled with such chaos and lack of planning that now things are beginning to backfire. And hence the capitulation, the folding, etc. So the truth to be told, I didn't change. I didn't flip my positions. I still the same guy. Same positions, same beliefs, same everything. But you know who changed? Is you guys. You guys changed. Last year, you were bearish because of a certain administration. Now, all of a sudden, you're bullish. You say the market is going to go up, China's going to do a deal, bond deals will go, not going to drop again, etc. You guys, when last year said that the manipulation of the bond market is bad, now this year, oh, it's actually good. Last year, insider trading was bad. This year, it's okay. It's fine. Last year, corruption was bad. This year, oh, it's totally fine right now. Dismantling freedom of speech. Last year was bad. This year it's good. You guys can roll that way if you'd like, but this is not my style. I'm here to give you objectivity, rationale, and challenge you by offering a different perspective than most. And I present my evidence and my reasoning for that every day. And the problem is, folks, you keep it up and keep making excuses to all of this, and I promise you, that's a promise. In less than 4 years, your next president is going to be Gavin Newsom and AOC. And that's going to be a disaster. But it's going to be so bad, Trump is going to screw up so bad that people in this country will gravitate toward the extreme left as a solution. And then you got nobody else to blame but yourself. Because you could have stood up and said, you know what? This is not what I voted for. This is wrong, not going to excuse it, and I'm going to make my voice heard. Maybe it will influence the administration to change course before it's too late. And the other point, again, it will be easier for me just to tell you what you want to hear, because the truth is, last year when we were criticizing the Biden administration's policies, we lost a lot of Democratic viewers. Didn't want to listen to the channel anymore, didn't want to subscribe to it, didn't want to be a member in it. And this year when we're criticizing the other side, the Trump administration, all of a sudden the viewers who liked this channel last year are now turning against it. And I'm not going to hide it from you. It is costing me, right? It's costing me members, subscribers when I say these things. But I don't really care for two reasons. Number one, why would I stand for something or defend something that doesn't make sense, that I don't agree with, just to please the audience? Again, not my style. Number two, I always believed in this, that a blessed dollar goes further than a cursed million. So sure, maybe it costs us a little bit, but at least we're telling the truth. And we have a clean conscience because of that. Try to explain to me this, by the way. Right? GDP comes out, stock market goes down big. Your boy comes out and says, oh, this is Biden's market. This is Biden's economy. In the afternoon, as we said, it's a bear trap. We're going to go higher again. We go higher, closing positive. He comes out and says, oh, this is my market now. And today, Trump came out in the Sunday shows saying that he takes credit for the good parts of the economy, blames the bad parts on Biden. try to twist yourself into a pretzel and tell me that this is right or this is the correct behavior from the leader of this economy in this country right now. Furthermore, the guy's falling into easy traps and amateur mistakes. You know it, and I know it. I'm willing to admit it. A lot of you are not. That's okay, because political biases are strong and it's hard to give up. But listen to this. I mean, we all heard these headlines when he came out and said, maybe you children, because the tariffs against China will cause a lot of gifts and toys and Christmas to be not available and become more expensive. So he said, instead of buying 30 dolls to your children, maybe you buy 2, which is an added touch, Marie Antoinette kind of comment. And think about the political ads that the opposite side is going to do when the midterms come. You're just handing them all of the ads. All what they have to do is just play that. Or the billionaire president think that your kids should have less dolls and less toys and accept living with less. It's not going to work out. It's going to end in a disaster, but maybe you need to see it to believe it. Anyhow, let's go back to the main topic of this video, which is how do we assess the market right now? Bull trap, bear market, recovery, what do we do at this point? I'm going to state for you the bullish developments that I think happened this week toward the market and the bearish developments too. Let's begin with the jobs report, which is both bullish and bearish for the market. Why? Let's explain. Bullish because the jobs report, while we had a lot of concerns about federal government workers, which we see huge declines as a result of Doge, yet at the same time we have themes in this economy that are really strong and sustainable. I talked about that numerous times last year, 23, 22, I've been talking about it, that we are an aging nation and we're going to need a lot of healthcare services jobs, and you cannot really, you're not going to shoot the seniors, right? You got to have to still have taxpayers pay for their medicine and for their care and all of that. So we need workers, and recession, no recession, stagflation, no stagflation. You still need those jobs. You're still going to have to pay for them. So we see that other sectors in the economy did produce jobs, according to this reading, mostly coming from health services and private education. And all in all, the economy created over 170,000 jobs last month. What was the dominant fear in the market in the last few weeks? Recession fears. Oh, we're going to dip into a recession. The clearest sign that we're dipping into a recession, which is the final piece of evidence, by the way. This is why we look at unemployment as a lagging indicator. But when you see unemployment moving higher, and specifically you begin to see loss of jobs, that becomes validation toward the recession fears. But when you see a number that blew past the estimates in a positive way, it soothes down the recession fears, and this is why the market rebounded on Friday. Now, why is the jobs number bearish for the market too? Because look at the result. Before the jobs number, the odds of a rate cut in the upcoming meeting by the Federal Reserve held the highest odds. After the reading, the odds now favor no cuts, meaning that when Jay Powell comes out this week, he's not going to cut. And that's going to resume, number one, going to resume the White House versus the Fed, which is chaotic, and the market doesn't like that at all. The market doesn't like when the White House attacks the Fed and threatens to fire the chairman. Number two, we all know that there are corners in the economy that are falling apart right now, and they need interest rate cuts. They need stimulation. They're not going to have it. And the market is not going to like the prospects of no rate cuts or delaying rate cuts. The market wants to see rate cuts right now. We go back to the board and we ask the question, though, why would the Federal Reserve hold the policy in this upcoming meeting and not cut? Well, how about in our bearish reasons? Inflation. What are we talking about? We got core PCE just this week or last week, and here's the reading. U.S. core PCE prices advanced actual, up 3.5%. The forecast was 3.1%, so beating the estimate, and the previous reading was 2.6%. So inflation is going in the wrong direction. Inflation is moving up, not down. Likewise, when you look at the index for traded food commodities, this has been sticky. It didn't go down, and it appears that it's heading its way higher. If that is the case, that's yet another evidence that inflation is still here, and inflation, matter of fact, is accelerating. Now, we all know that tariffs are inflationary. We talked about how 75% of respondents in the poll, 75%, the majority, know that tariffs will cause increases in pricing, aka increasing in inflation, which can handicap the Fed from cutting rates. We have new polling this week, and in the question of the impact of the Trump handling of the tariffs, 64% disapprove. 71% of respondents say that it's going to have a negative effect on inflation, meaning pushing inflation higher. 71%. That's in alignment with the polls that we've seen last week. How about creating manufacturing jobs? 59% say positive. So it's not all bad. But as we said before, is it worth it? Is the price worth it to create a few manufacturing jobs that will be taken over by AI sooner than later? And manufacturing is a tiny little contribution to our economy anyways. Anyhow, the impact on Trump handling of tariffs on U.S. economic leadership, 56% have a negative view on that. So again, my views and my opinions are in alignment with the majority of the U.S. public, including, by the way, soon enough, Republicans. They're going to come around. It's just going to take them a little bit of time. In the same poll that we got from ABC, roughly 47% of Republicans think that tariffs will negatively impact inflation. 47%, almost half, understand and acknowledge that. And this number is going to go higher and higher as you begin to see the actual impact of the tariffs on the stuff that you buy every day, every week, when your kids go to school, back to school. You'll see all of that. And more people are going to have a negative view toward the tariffs because it is causing higher inflation. Another piece of evidence that we got this week that says, hey, Fed, don't do it. Don't cut rates, even if it means that the White House is going to be pissed off. We got the manufacturing PMI. And this is the most important part. Chris Williamson, the chief economist at the S&P, says concerns have also spiked in terms of input cost. This is, of course, among manufacturers, especially for imported materials and components, due to the triple whammy of tariff-related price hikes, supply shortages, and the weaker dollar. Listen to this. This is really important. Manufacturers are responding to these changing demand, supply, and cost conditions by raising their selling prices and trimming headcount to help protect their margins. In other words, more inflation is coming your way, baby. There's no way you're going to avoid that. And again, was I ever an advocate for inflation, or did I ever say that inflation is good? Never. Inflation destroys the working class of any economy. It only rewards the rich. So keep that in mind. But again, more and more evidence that inflation is going to be a big challenge, and it's extremely high risk for the Fed to cut rates right now. I think that's going to be bad for the market if the Fed doesn't cut rates this week. Because on the other hand, this is what we have. Here's the headline from the Wall Street Journal. It reads, middle-income consumers feel pinched. That is bad for some of America's best-known brands. We've seen anything that has consumer exposure and earnings this week was disastrous. And we made a video this week. We talked about the MEC recession. The McDonald's earnings showed that sales in the U.S. are down over 3%. Consumers so broke and so uncertain that they cannot even afford McDonald's, which traditionally is recession-proof. That's how bad the economy really is. But even with that, the Federal Reserve cannot cut rates right now. And we go back to the board. In our bullish reasons that counters the inflation narrative on the bearish side is OPEC+. So we got the news that Saudi Arabia was frustrated by some countries in OPEC Plus organization who were not really holding the quotas, the cuts. So Saudi cuts, the prices go up. Other producers like Iraq, like Kazakhstan, UAE, and many others begin pumping more, taking advantage of higher prices, making more revenue while Saudi doesn't enjoy as much benefit. So now what they're doing is using the so-called nuclear option of, hey, we're going to pump the market with a lot of supply right now, crush the prices down and see what the reaction is. Maybe you're going to learn your lesson this time. Again, the more they abuse the nuclear option, the more it becomes ineffective. But this time around, it's still effective in dropping oil prices down, or we'll see if there is a change by the other producers or not. Here's more details for you. And keep in mind that lower oil prices is the positive side. It's the only positive things that are happening in inflation right now is crude oil is down. Anyhow, here's the details for you. The latest hike of more than 400,000 barrels a day from June matched a similar increase announced last month when the group made the shock decision to bring back triple the planned volume for May. The alliance, led by Saudi Arabia and Russia, has been reversing prolonged output curbs that were meant to support prices, but which costed market share to rival drillers. After the meeting, Saudi Arabia signaled further similar-sized increases could follow, according to the delegates. The move by the Organization of the Petroleum Exporting Nations and its allies has stoked bumper trading volumes, with around 180,000 lots of Brent traded across the curve in the first half an hour of Asian session, which, by the way, tells me that maybe oil is down so much that it is at least a swing trading opportunity. I mean, you look at the chart of light crude here. It is gapping below the lower Bollinger Bands, but holding sort of a double bottom right now. And I'm going to take an opportunity Monday. There's no guarantee it's going to work out, but I'm going to take a shot. I'm going to buy some contracts of crude oil futures, betting that we're going to have a swing rebound. But again, we go back to the board. The fact that OPEC Plus is going to war among each other, civil war. That means good news about inflation, but is it enough? That's what the challenge is going to be in the FOMC this week. Going back to the board, what is bullish? Trade war peak. What are we talking about? You escalate things and it gets crazy and as chaotic and intense as it can. But at some point, you can't escalate anymore. And we already got word from China. They're not going to escalate. They're going to ignore any more extra tariffs that the Trump administration is going to impose. And the Trump administration so far did not hit China back when China said we're going to increase the tariffs on U.S. goods by 125%. So at least we have a ceiling for what the tariff rate is going to be. And now we're beginning to get some good news, such as the Canadian Prime Minister. He's visiting the White House this week to discuss trade. And maybe there is a glimpse of hope that we could get a deal or some sort of an agreement. Likewise, on Friday, we got China. China says it is open to trade talks, but high tariffs remain an obstacle. So at least China is also saying, hey, we're open. We want to talk about it. And of course, Trump signals willingness to lower China tariffs at some point, though. That's the good news, that maybe we've already seen the ugly part of the trade war, and now it's going to ease up a little bit. On the other hand, we go back to the board. What is bearish? It's Trump's psychology. What are we talking about? Here it is. Headline from Fox News reads, Trump says he will not drop the tariffs to get China to the negotiation table. And China made it clear, we're not going to come to the negotiation table without removing the tariffs or lowering the tariffs. Well, now Trump says, I'm not going to do it. And if the market continues to go higher and rebound, he might be encouraged to resume the hostility again. Another headline for you from Axios. Trump says tariffs could be permanent, but strikes softer note on China. Now, you can be as optimistic as you want on the trade front that, Canada might make a deal, China might make a deal, India might make a deal. Good. Here's the problem, though. The goal from the policy is to replace or reduce income taxes as a source of revenue for the government and replace that with tariffs. If that is the goal, then you cannot really reduce the tariffs dramatically. They have to stay high and they have to be permanent. And we can play these games of, a rebound in the market because of optimism. But sooner or later, the reality sinks in that these tariffs are permanent. Maybe they're not going to do 145%. That's not sustainable, but they're going to go to 50 or even 30. That's still too much. That's still going to reduce growth by a lot. We already see the impact on the changes in consumer behavior. So the headline reads, dumpster fire. Retailers urge shoppers to buy now before the tariffs raise prices. And a lot of shoppers are doing this right now. Talk to any dealership, all of a sudden business went higher because folks are like, if I want to buy a car, better buy it right now before it's 25% more expensive. If I want to buy a washing machine, I want to buy a fridge or buy anything, better buy it now before it gets more expensive. And that's going to spike retail sales temporarily, of course. What it's going to do, tariff or no tariff down the line, is the consumer already front-loaded the spending, so we're going to have a quiet ghost town summer, maybe beyond spending by the consumer. And that's going to be bad. That's not going to fluff up corporate earnings and cause the market to go higher. Let's go back to the board. Among our bullish reasons, earnings. And among our bearish reasons, also earnings. With a really important distinction. The bullish earnings are B2B, business to business. The bearish side is earnings when business to consumer, B2C, is the main focus. So we talked about McDonald's, we talked about Starbucks, we talked about Harley Davidson, we talked about Chipotle, we talked about Mondelez, we talked about PepsiCo, we talked about Coke. Many of the companies, retail businesses, consumer brands are saying the consumer is so afraid that they're beginning to cut spending. And that's recessionary. That's bearish. That's not bullish. But of course, disparity in the economy is not just between the affluent consumer, the 1%, and the rest of us. We see the disparity within the stock market and within corporations. The have and have-nots. And the have-nots are businesses that have any exposure to the consumer. But businesses that buy and sell among each other are doing fine. But of course, there is one problem, that even among the Mag 7 or the big cap technology stocks, or the companies that we have, you look at Google, Meta, Microsoft, these companies are mostly B2B. And we got earnings from these companies and they look fine. And these companies are spending still like a drunken sailor. Most important finding this week is despite all of this uncertainty that we have, these companies have yet, keyword yet, to cut CapEx. In Meta, for example, they're actually doubling down and increasing CapEx. Okay, maybe we're talking about 50 billion here, 80 billion there, 100 billion there. That money's going to go somewhere. and cause economic benefit. Hold that thought, because on the other side, you have Apple and Amazon. Apple, of course, B2C. If the consumer is weak, we got a problem. And this is why Apple was the worst performer after earnings. Everything is stagnant in the company. And this is, of course, the biggest weight in the stock market. Everything is stagnant, including, by the way, the theft revenue, aka the services revenue, where they steal from other people's work just because, which is coming under scrutiny, by the way, here and in Europe, which is a good thing. But even that revenue, which was the biggest source of growth in Apple, has now slowed down dramatically. And of course, you have Amazon. AWS is high growth, B2B, but AWS is a small component of Amazon's earnings when you pin it against, let's say, North America sales or international sales. Both are stagnant and heading down. And this is why Amazon performed worse after earnings. Caught a little bit of a rebound Friday because everything did, but if I had to bet, I would say that Amazon goes down again because of that B2C exposure. You don't want that. Now you got to focus on B2B. So no more B2C. Let's talk about B2B. The problem, of course, with these companies is they're going to spend like a drunken sailor. For example, Microsoft, when I did the earnings review this week for the members, I showed you that CapEx growth year on year, 35.7%. On the other hand, operating income growth is only 16%, which is not bad, but there's a huge gap between CapEx and op income. And any problem in the economy, any slowdown in consumption, any slowdown in buying, you're going to see a problem right away in these kind of stocks because profitability will go down, will plummet dramatically. We'll have the same problem that we had with these names back in 22. And of course, they're going to respond to reducing CapEx, but that's going to be late. That's going to be after the stock is already down 20, 30, 40%. So I'm not suggesting that Google, Meta, Microsoft are good places to be, even though Microsoft at least cut CapEx spending a little bit. But I'm talking about what they're spending on. And there are three types of companies they're spending on. You got your chips components like NVIDIA, AMAT, Micron, ASML, Lam Research, and many more. You have data center spending like Broadcom, Arista, Vertiv, Dell, Digital Realty, and many more. Then you have the energy side of data center spending, which is Vestra, GE, Vernova, Constellation Energy. The problem with the chip spending is a lot of that was already front-loaded in 23 and 24. The company's already stocked up in chips. And the only way that we will see stimulation in spending in chips and equipment to make chips is if they lower the prices, if NVIDIA lowers the price dramatically, which will cause contraction in margins, and that's not going to be good for the stock. The same thing in data centers. You got to be careful here with the data centers because a lot of that spending was also front-loaded. And it's going to be really, really sensitive to more economic weakness, that the companies would say, you know what, we can pause spending on these data center equipments for now. So not my favorite corner to be in here or to chase. But the energy corner is more interesting because they have to secure the sources of energy to their planned data centers now. And the fact that they're spending, they didn't cut any spending, Meta, Google, Microsoft, even Amazon spending, insane CapEx gap between CapEx and op income. But anyways, a lot of that money is going to the companies that are producing energy for data centers. And right now, the leaders are Vestra, GE, Vernova, Constellation. So if you must chase anything from what we got from earnings this week, I think the energy corner makes more sense. Now, bear in mind that we have earnings coming for these companies, so maybe you want to wait and see what they have to say before you hop in. And now that we talked about the market dynamics, given the macro and the earnings that we got this week, let's segue to the strategy. What do we do with this market right now? Because last week, the strategy was pretty much this trade right here. We sold the credit spread, call credit spread on the SPY. So we sold the 555. We bought the 560. The expiration date was April 28. And then we bought the 555 calls. We sold the 560 for the expiration date of the second, in what I call as the Maverick Wing strategy. We paid about $1.20 a piece. But guess what? Comes Monday, market pulls back. We capture the entirety of the credit from the spread. And then by Friday, we're trading above 560. You leave that leg to expire and you net $5. So we turned $1.20 a piece to $5 by the end of the week. That is a triple-digit gain. What do we do this week? Here's my weekend note in my Discord. I said since we got double rescue today, yet the market is technically extended and ready to retreat. Here's my strategy. Number one, keep bearish exposure via the bearish legs in Apple and Amazon in the lotto tickets. So before earnings, I give you these lotto tickets where we try to play a neutral strategy. We don't care if the stock goes up or down so long as it goes beyond what the market maker is pricing in. We net profits, so we do that via double calendar spreads or inverse Iron Condor spreads. We've done those on Apple. We've done those on Amazon. I gave you some advanced strategies too that I followed, like the calendar Jade Lizard or the bear core ladder in combination of a calendar put spread in Amazon, which I think it's going to be a phenomenal trade if Amazon continues to go down all the way to the 16th because they only cost 20 cents. So we want to keep the bearish legs of these trades open in case the market go down. We benefit from that. Number 2, back to the note. The Microsoft Lotto ticket has to be closed today, yet Microsoft chart is very extended above the upper Bollinger Band, so I decided to close the whole calendar call spread at 420, netting about 1.6 bucks in credit, and I sold credit spread for next week by selling the 435 calls. I'm buying the 440 calls, netting a credit off 2.35. So this was a result of a Lotto ticket that we've done a double calendar, and this is the downside of doing a double calendar strategy, is we picked the call leg as 420. Well, guess what? Amazon blew past 420. So what happens now is that you're obligated for the leg that you sold for this week or the week that was. You can hold on to the leg that you got for next week, but it's going to cost you a lot to buy the leg that you sold for this week. Because the double calendar strategy is to sell a shorter expiration date calls or puts and then buy a longer dated call or put at the same strike price. But if the stock goes beyond the boundaries that you picked, then it ruins the whole trade. But if you look at Microsoft's chart, daily chart, we're gapping above the upper Bollinger Bands. And this is why I decided to shift the strategy toward the credit spread. That way, if there's any pullback, and again, it's reasonable and rational for the chart to pull back and go within the Bollinger Bands. And if that happens, we net the entirety of the credit. So we net the 235 and we already got $1.60 from the trade that we're already done. We go back to the note. Number 3, since the SPY 200 DMA became a psychological target, and you look at the chart right here for the S&P 500, really close to the 200 days moving average, maybe the market wants to retest the 200 before it makes up its mind or retreat or reverse. So we need some bullish exposure, but I don't want to spend too much on it. So here's what I did. I bought the 570, 575 call credit spread expiration date May 6. And then I financed the trade by selling the 575, 580 call credit spread for a longer dated expiration date, which is the 9th. All in all, costing me 30 cents to play. And this is, by the way, the inverse of what we've done last week. So last week, we bought a call credit spread for a longer expiration date, and we sold the credit for a shorter. This week, I did the opposite. So here's what I said. I did this because I think short term, we might hit the 200 DMA, but the chart will stall and reverse after that. Do your homework and follow only if you agree, because I could be an absolute donkey about this. So I don't have a lot of conviction in this, but this is the trade right here. For the 6th, again, you're buying the 570, you're selling the 575. And for the 9th, you're selling the 575, buying the 580. All in all, costs you 30 cents. If the SPY trades above 570 before or on the 6th of this month, you net profits from this trade. If not, you only had exposure for 30 cents. So we didn't overinvest. So that is the strategy for the week, but let's do some technical analysis here because the indicators are going to be really important. We begin with the rebound checklist. We have Dixie stability. We want to see stability in the US dollar. We don't want to see it flushing down like past few weeks because that's indicative of dumping of the US dollar, aka resumption of the recession fears here. Then we got gold pullback. What that means is we need to see outflows out of gold, which was the defensive/resources safety during the chaos in the market. We need to see that money rotating back to equities. Absent of that, we got a problem. And then we had the VIX 2-hour MACD, which has to be updated. Now we're going to look at the daily chart, but the 2-hour did its job in making us avoid falling into a bear trap last Thursday. We'll talk and show you those charts in a minute, but we got HYG above the 200 DMA. You want to see credit stability, so we didn't want to see a recovery above the 200 DMA means a recovery, but we'll look at the chart in a minute. Crude above 64, that's not happening. At least not right now. We want to see the 10-year yield also below 4.3 because if yields continue to spike, then that's indicative of two things. The Federal Reserve not cutting rates, and number 2, the dumping of bonds being resumed. The last condition or rebound checklist is we want to see Bitcoin still trading above the 200 DMA and not reversing in a bad way. So let's look at some of these charts right here, beginning with the dollar. The dollar faced the 20 days moving average. You see that wide line between the Bollinger Bands? That's the 20 days moving average. And it looks right now, at least, that there is sort of a rejection going on. And as the dollar goes down, you see stock futures also going down with it. On the other hand, we'll keep an open mind because this could be a formation of an inverse head and shoulder pattern. We look at the gold futures chart. What do we see here? We talked about the bear flag formation. We broke below. I still think that gold has a good chance of revisiting the 50 days moving average in blue, but at least tonight, gold futures are trading higher while the dollar goes down. And again, that's not good for the equities market because you want to see all of that fear money that got into gold to rotate back into equities. And if that's not happening, we see more inflows into gold. That's going to be a negative because it's going to come at the market's expense. Sell your stocks, buy gold. And we'll look at the VIX chart. Again, we're going to look at the daily, not the 2 hours. The 2 hours did its job for this week. Now we look at the daily chart of the VIX. We have a gap, which I'm going to call the rebound zone. You need to see the VIX lasting through that rebound zone and going down in a flush to have any confirmation that the rebound or the market is bullish right now. But if we see a rebound in the VIX at this point, at this zone, it's going to be problematic because it's going to indicate that we have a second wave or a second leg in the pop that we've seen in the VIX in the month of April. We're going to see another one in June, maybe as soon as May. So we'll keep an eye. Then you look at the HYG, High Yield Corporate Bond ETF, touched the 200, but then began to trade down. For now, just an early little warning sign, but it's not saying that, oh, we lost 78, which at that point it will be okay. The HYG is reversing down. That's negative for the equities market. So we'll keep it in mind for now. Then we'll look at the 10-year bond yield. We talked about the falling wedge pattern. We got a pop on Friday because of the jobs number, which is indicative that the Fed is not going to cut rates. And oh, by the way, we might resume dumping bonds. That's not good for the market. You need to see yields not flushing down either, but you need them to stabilize right underneath 4.3%. Then we'll look at Bitcoin, still above the 200 days moving average in orange. That's the line of the 200 days moving average. Still above 92,000. Still have sort of a bull flag pattern, but the problem is, look at the MACD indicator. It is beginning to reverse. Look at the RSI's negative divergence. Look at the Vortex indicator. The red line is moving up, the blue is moving down. That's indicative of perhaps the move higher in Bitcoin has peaked. And if Bitcoin goes down and blasts through the 200 days moving average, that's going to be problematic because Bitcoin is an indicator for sentiment. If you see Bitcoin going higher, then we have more appetite of risk taking by at least the retail investors. We don't want to see that reversing. If you see it, it's going to be bearish, not bullish. So as you can see, things are changing a little bit in the indicators, and that might lead us to a bull trap and a market decline being resumed. But we'll cover it, of course, day by day. And this is why I encourage all of you folks to join us as a Maverick member here on YouTube or Patreon so you don't miss out on the conversations we're having throughout the week. But let's move on to the conclusion of this video. What do we have on the economic calendar this week? Monday the 5th, we have services PMI, as important as the manufacturing PMI, because if you see prices going higher in services, that's going to be yet another problem. Then Tuesday, May 6th, we have the trade deficit. It's more relevant than ever because of the trade war. Then Wednesday, the 7th, we have most important day of the week, FOMC meeting. And Chairman Powell, let's see what he's going to say, what he's going to do, and whether he's going to have the balls to actually go and face the White House and give them the middle finger and say, not cutting rates. I don't see the evidence, not going to do it. I don't care how much pressure you're going to add on me. But on the other hand, Powell is a weak man, so anything is possible, really. Thursday, May 8th, initial jobless claims, U.S. productivity, wholesales inventories. By the way, if Fed Chairman Powell cuts rates, prepare for a huge surge in inflation. Huge. Anyhow, Friday the 9th, we have a bunch of Fed zombies talking from all over the place. Governor Barr from New York, from Governor Kugler from Richmond, from Christopher Waller, from Boston, Cook, all over the place. They're just zombies. They talk. Who gives a shit? But then we have the earnings calendar. The most important names are behind us now, but we still got really critical names and indicators for the economy. You think about Uber as an indicator for the economy. That's a big one, a huge one. You have Disney, you have AMD, you have ARM, Shopify, you have ConocoPhillips, AppLovin, it's an important one, Duke Energy, and the list goes on, folks. We have Mickelson, we have DoorDash, another important one about the consumer. Constellation Energy, we just talked about the data center spending. We have Marriott, another indicator about the consumer and travel demand in the economy when we heard all of these headlines that folks are boycotting traveling to the U.S. We have Emerson, so we have a really eventful week of both earnings and macro data. We'll cover all of it live, folks. But for now, this is all I got for you, folks. If you found this program informative, return the favor by subscribing, pressing the like button, leaving us a nice comment in the comment section, and better yet, consider joining us as a Maverick member, YouTube, Patreon. All of the links are in the description. But once again, folks, thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
I find your lack of faith disturbing.